Okay, hi everyone. I'm Hadass from the Popular Investor team. Heloise, you can start now. Just please, everyone, make sure that you're muted because I can see some people have unmuted themselves. But great, Heloise, you can start.
Brilliant. Thanks, Hadass. Hi, everyone. Great to have you all on the Q3 quarterly update call. I'm almost like tempted to, I wish I could do a poll to see how many of you have been to these before and how many of you are here for the first time. But yeah, great to have you all here. So for those who have been here, you'll know the agenda. It's a brief introduction about myself. So sorry if you've seen that before. And yeah, just like a brief overview for those of you who are joining for the first time. And then I'll dive a bit into my portfolio strategy and my economic analysis and talk about how I've adjusted it over the last quarter and give some forecasts and plans for the future. At the same time, I wanted to be a bit informal. So if you have any questions, please just pop them in the chat. I'm gonna keep an eye on it as we go along. So you can save them for the end or just put them in the chat. If I spot them, I'll address them straight away. Seeing lots of people saying first time. That's great. Welcome, everyone. So yeah, a lot of you know me as rubymza on the platform, but some of you now follow me on Instagram and Twitter under my handle name Greeff Invest. And yeah, some of you may have realized that my full name is Heloïse Greeff, despite my very random name on eToro. So just a brief introduction about myself. I'm originally from South Africa, and I've always been a serial nerd. I studied mechatronics engineering, which is now, I think, called robotics, and then did a dual program with the University of Cape Town and the MIT Media Lab in inclusive innovation before coming to the UK in 2013 as a Rhodes Scholar, where I studied biomedical engineering and did an MBA at the University of Oxford. So after that, I left the UK to go and live in East Africa, where I worked as a data science consultant and a product manager for a bunch of startups in the region, as well as running a project for Microsoft Garage in India and rolling it out in Kenya, Tanzania, and Uganda. I then came back to the UK to do a PhD in machine learning, where I now hold 2 patents and a number of academic publications. I've gotten a number of awards for my work, and most of it is related to AI and tech. I was invited to be a red judge for the IBM Watson AI X Prize, and this year will be my 2nd year as a Royal Academy of Engineering Africa Innovation Prize judge. So yeah, I really have been working in the AI and tech space for a long time. I typically work on really complex data sets in limited resource settings. I just find them much more challenging and exciting. And of course, I bring that skill set to the complexity of looking at economic data, stocks and share prices, and so forth, which I bring into my trading. Some of you may already know this, but I think I'm one of the few elite pro popular investors on eToro who are not full-time. So what else do I get up to? I continue to work as a research fellow at the University of Oxford, where I'm specifically looking at using AI, wearables, and other technologies to monitor patient deterioration in limited resource settings. I'm also a board member of the Australian startup called MyRaphael, which is using wearables and AI to monitor COVID-19. And then I also serve as an enterprise and innovation fellow at the university, where I'm helping to translate some of the research into industry using both my expertise of my time in industry and my time in academia. So since we last met, I have kept my copiers constant at 20,000, but I've grown my AUM to just over 40 million. It was, I think, 30 million when we met for the last update call, which is always great because it shows that one is, I'm basically, I guess, I take it as a sign that I've earned your trust, and that with the same number of copiers, the kind of investment per copier has grown as people, both as I grow their original investment, but also as some people choose to add more to their original investment. And since we last met, I also have been featured in the Times next to Warren Buffett. And then following that, I did an in-depth interview with Anna Kubin, which some of you may have seen in Business Insider, which, yeah, I'll keep sharing these with you. I hope you find them interesting and that you learn a little bit about me every time, or at least if you are not learning anything new about me, you'll realize that if anything, I'm consistent in what I say. So it's also shared on my page. There's a URL at the bottom. I think it's a really wonderful resource which eToro puts out, and I always encourage people to familiarize themselves with it. I think there are a number of amazing popular investors on the platform right now, and I don't envy you for having to choose between all of us. And I know like many people have not only me in their portfolio, but they have other people as well. So I think this is kind of a useful tool to compare across, comparing apples to apples and deciding what is a good fit for you. So one thing I think I wanted to highlight in the fact sheet. So here I have my sheet from January where it showed that my total return on eToro was 130%. And then this one is the latest one from June, which is showing the total return is 162%, but our year-to-date return has only been 70%. So why has there been a 30% total return if we've only done 17% for the same period? And that's really the power of compounded returns. So some of you have sometimes asked me, why do I close and like very soon after open a position in the same stock? That's purely because I'm taking out the profits, and I will sometimes reallocate those profits into the same stock if I think that that's part of the long-term strategy, or I will kind of use it somewhere else in the portfolio. So that's really just the power of having compounded returns over a long period of time. And then the stats down here are really useful too as well. Specifically, I think the Sharpe ratio is a really important tool to look at. That's kind of your risk-adjusted return. So it tells you what your expected return can be for every kind of dollar of exposure that you have. And then also the correlation to the S&P. So yeah, have a look at those, compare them across the different PIs. And as I always say, like, try and diversify your portfolio, try to include not only me, but others as well, because I think there's some really great people on the platform. So just told you I'm an engineer. What am I doing? Like many of you, to eToro and around that would, have low kind of commissions and fees that would allow me to kind of try my hand at directly investing in the stock market and not through a broker, which sometimes can be have a time delay or have a significant cost over time. So yeah, you can just see on my growth here. I joined in 2016, was eager to learn. I was day trading oil at one point, so you can kind of see my downward learning curve, but just kind of kept going at it. And I think I really honed my skills over time. And then in 2019, I became a popular investor and have just kind of stuck to that strategy, which has really paid off over the last 2 years. Just having a look at the questions, take them at the end. So yeah, let's look at my view of the market and the portfolio composition and the strategy. So my investment strategy is fairly consistent. Nothing in this has changed, although I will go through how some of the allocations in the portfolio has changed over the last quarter. So my portfolio is a long-term stock portfolio predominantly, and I have a mix of value and growth. It used to be quite heavy on the growth side. Again, you'll see in the reallocation of the compositions how that has changed in the last quarter. I tend to keep quite a balanced portfolio by diversifying across different sectors as well as different regions. Again, I'll show you in depth how that has been readjusted over the last quarter. And I tend to try and keep the risk score low to medium by hedging other asset classes. And I very, very, very rarely use leverage, which means we have low or no fees in the portfolio. So for my analysis, I find interesting. And then probably this will answer somebody's question about how do I use AI in my trading. I have a proprietary machine learning algorithm, which I wrote a few years back, that I use to identify what I think are good entry and exit points for the stocks, which I've then identified. I don't use it as a trigger, so it's not a black box which does anything automatically. I just use it as an extra decision, basically a decision support tool, essentially, to help me decide whether it's a good time to get into that stock. And then I also have been quoted in the Bloomberg for my approach of using social trading platforms like eToro as an additional data point to look at the hive mind of retail investors to pick up some of the cultural trends that we might be expecting. My last sentence was just around the use of the hive mind as an additional data point, which is something that we've never had access to before, I think, as investors, to understand some of the long-term cultural trends that might help us predict how things will or could potentially change into the future. So I'm going to do a review of the whole first half of the year because it's been a really interesting year in many ways before I move on to kind of forecasting the next half of the year. So if we look at the performance, I mean, I think nobody expected this year to do as well as it has so far, given all of the disruptions in 2020. We continue to see strong, robust economic growth in a lot of the major economies. We saw really strong corporate earnings, which just beat expectations on almost all of the cases. Interest rates remain really low, and in the bond market, we continue to see corporate bonds outperforming government bonds. And why is this unusual? Because I think this should come with a bit of a warning flag for all of us. When things are going too well for too long, you should always just take a minute and kind of reflect on what this might mean. So this was the strongest first half in the stock market in 9 years, and it's the second best in 23 years. So the stock market has delivered, I think it was about 12% at the end of June, which already it's delivered more than its average annual return in only 6 months and half the year, essentially. And so if we continue at this trajectory or even just hold at this pace, we could potentially see a third consecutive double-digit year, 50 years. So in 2018, the market was down. Of course, those of you who've been with me for a long time will know that we are currently in our 5th year of being green or being in profit. So we did not have the losses of 2018, but it is very unusual, and we should kind of prepare for things to for the tides to turn, although a lot of the outlook is still very bullish for the second half of the year, although could probably expect to see a lot slower growth, maybe 2 to 3%, and not the kind of immense growth that we've seen so far. And then thirdly, the other thing which has been unusual is the seasonality, which usually comes annually, has not been that prevalent this year. So usually we see a strong first half and then a weaker third quarter, which is, it's just all a bit out of play with the pandemic kind of shifting everything out of sync. So on the one end, we should be celebrating we've had a tough but a good start to the year, but at the same time we should be cautiously optimistic about the second half of the year. So some of the major events that we've seen, I'm just trying to turn this back on. Some of the major events that we've seen is, well, I mean, the pandemic is still in front of everybody's minds. The vaccination campaigns continue to be accelerated. We were off to a bit of a slow start in some countries. That's starting to pick up. The Economist recently had a really interesting article about the fault lines in our economies and how vaxxers versus non-vaxxers is going to be a really big divider going forward. And I think like a country like Japan is already feeling the effect of that, as they've not been that strong with their vaccinations, and they've currently gone back into lockdown. So that continues to be a main theme. The second one, which we tend to forget about, which is quite a significant event, was Brexit, which happened at the end of last year, basically December, but we kind of saw the impact or effects of that going into 2021. So this is when the UK was released from the EU. And it's been really interesting in many ways, because through a combination of policy support, pent-up demand, as well as savings because of the lockdown, and then the fairly successful vaccine program, which we've seen in the UK, have all really helped to drive strong economic recovery in the UK, which has put the UK markets in a lot of favor with international investors, purely on valuation grounds. So in our portfolio, we have a few strong positions in the UK from last year, which I'm holding on to. But when I show the contribution breakdown by region, you'll also see how we've shifted that to be a bit take advantage of that into the second half of the year. And then thirdly, I guess we can't talk about major events without talking about China. It kind of started with the trade wars at the end of last year, and then I think there was a lot of optimism in the markets that once Biden takes office, there'll be more conciliatory approach towards China, which, if anything, has quite not been the case. If anything, there's been quite a number of aggressive orders against China, specifically, the imports of solar panels based on human rights grounds, then the additional campaigns that have been added, companies that have been added to the blacklist, and the broad review of technology security to fend off kind of foreign adversaries have included China in that list. And then China itself has made a couple of, strong moves to unfavor itself with the global market in terms of, closing down some of their tech startups and just changing regulations, which are not seen as very favorable by the international investor community. But I think the final kind of nail in the coffin has been the recent passage of the $250 billion bill by the US to fund the kind of race against technological leadership and to make sure that they keep some pressure on their rival in China. So it's, you know, it was never going to be an easy race for China to the top, but I think the the US has kind of made that even harder. And so it's been quite an interesting one to watch. We don't have a lot of exposure to China in the portfolio, so it's not really affected us that much. I think we only have Alibaba and Baidu. So yeah, I've never been overly kind of bullish on the Chinese market, so we've not been that affected by the recent sell-off of the Chinese markets. But yeah, it is an important one to keep watching because it influences a lot of other things. So how is the portfolio done in the first half? We kind of keep inching every day. Some days we're just slightly ahead of the S&P, some days we're slightly lagging. When I checked yesterday, we were kind of neck and neck. Overall, I'm not too worried yet because in a kind of rolling year, we're still more than 10% ahead of the S&P. And I think some of the changes to the portfolio I'll go through with you in a minute will kind of put us in a strong position for the second half. So what does our forecast look like for the second half of the year? I always like to take the two extreme views because I think the truth is always somewhere in the middle. So if we look at the very optimistic or positive outlook, we've seen the vaccine being very effective in reducing the number of hospital cases, which has been very positive for economies reopening, driving recovery. And I think the main thing is to have very little or no lockdowns going forward because these have a very significant impact on the economies. The debate is still ongoing about whether inflation is transitory or not. In a positive view, it will be, and it will just kind of be part of this phase where economies are reopening. But yeah, I think I'm quite positive in that both the US and the UK are doing a lot to stimulate their local manufacturing, getting their workforce back into the market as they're in different phases of phasing out different stimulus packages in the near and long-term, middle-term future. In the kind of negative view, I think we still have a threat of new strains of the coronavirus and not understanding kind of how the vaccine will cope with that. Probably the bigger impact of the hesitation for recovery, despite and being accelerated by the structural shift. I think what this opening, closing, reopening and closing has done in a lot of economies, it's kind of, you know, just like numbed down the excitement for reopening. At least that's what we're seeing in the UK. Businesses are a lot more careful about reopening and going kind of full throttle this time than they were a year ago when we came out of our first lockdown. So that's really kind of stunting a bit of the recovery that we would hope to see. Of course, inflation might rise, interest rates might rise, and we really will only see the true impact of the last year once all the stimulus packages end, although that's been kicked to a bit more to the future. And then, of course, there's the constant talk about the economies or the stock market being in a bubble and that we're due for a correction or a collapse. Again, as I said, I think the truth is kind of somewhere in the middle. These are the two extremes. We might get a little bit of the one and a little bit of the other. And so preparing for that, I think the portfolio is really well placed by preparing for multiple scenarios. But the main thing is that we should be expecting lower returns in the second half of this year, as well as increased volatility, even more than we've seen so far. So with that, I'll just quickly go over the portfolio composition and maybe highlight some of the changes that I've brought in the last quarter to prepare for us going into the second half of the year. So if we look at it by sector breakdown, my portfolio has always been quite heavy on tech and healthcare. And that has now shifted quite a bit to make sure that we are a lot more diversified, including, for instance, construction and natural resources, which haven't been there before, but are like kind of good plays for these recovery periods. And then also a post which I recently made about measuring tech companies explicitly in portfolios and how that's changing as tech becomes more integrated into different other sectors. I mean, a classic example of this, I think, is Tesla. Is it an automotive company? Is it a tech company? Is it an energy company? Is it a battery company? Like, where do you put it? So I think we'll see more and more of those blurred lines going forward. And so we're quite heavily placed on the financial sector at the moment. I think the US banks have seen quite a strong return as economies have reopened. I've not included a lot of the US banks. I've included more UK and European banks because I think they've not seen the same recovery that we've already seen in the US. And so that's the reason I've gone more for those. In terms of our geographic breakdown, then again, the portfolio used to be almost 80% plus US with a little bit of UK. We now have a lot more exposure to UK and Europe, again, for the same reason, just diversifying across different geographies, and also getting the benefit of kind of the different phases of recovery that different countries may be in at different periods. So I think going forward, you could only expect to see perhaps a further trim down of US in the portfolio, but definitely this will be kind of the maximum that it'll be kept at. And I've explicitly kind of separated the UK and Europe, partly because of Brexit. I think they're slightly at different phases, but again, also because of the different kind of rates of the vaccine rollouts in the two, they're kind of progressing differently. So I've just separated them for that reason. In terms of size and strategy breakdown, again, trimmed down some of our kind of growth stocks. We used to be predominantly exposed to growth stocks. Just again, have added a lot of sectors and stocks, which gives us more value stocks, which have been doing quite well and are expected to do well in these recovery phases. So I think with this recomposition of the portfolio over the last quarter, I'm fairly confident that we'll go into the second half very well prepared for a lot of the volatility and uncertainty that is there, because it gives us really good diversification for the volatility. In terms of future views, just a bit specific themes for the rest of the year and perhaps even beyond. There's a lot of talk about kind of the hospitality industry reopening, which of course will kind of drive recovery in that sector. But one thing which I've been quite interested in is how remote work will change people's need for the hospitality industry, and specifically, if people are going to continue working remotely, will we see a bigger trend towards nomadic lifestyles, and will there be a shift in demand for short-term accommodation to kind of medium-term accommodation? So that's one of the things that I'm kind of more interested in, rather than just the strict reopening of travel, because I think that's fairly complicated at the moment. And so I think in the immediate term, we might see more of the nomadic lifestyles driving some of that. Of course, a big event later this year is COP26 and a focus on kind of carbon. So the focus has gone a bit away from negative things. I think we've all had a lot this year with the pandemic. So rather than talking about climate emergencies, I think the focus is now quite heavily on the net zero goal, and how Europe might reach that with their carbon scheme. I'm currently helping to organize the Enterprise Summit in Oxford, which will be just after the COP26 summit. And we're inviting a lot of the same speakers to kind of just delve into their enterprise opportunities for that, which will follow once everything has been announced. So that'll be quite an interesting one to look out for. And then just some other key innovation trends. I think still solar, EV, driverless cars, as I mentioned before. I like to look more a bit at the indirect kind of knock-on effects of these rather than just the direct. So if we have driverless cars, for instance, what are we going to do with the time of the user, the person who would have been driving before? We now have their time, their attention, and what are they going to be spending that time on during that time? And then biotechnology readiness, I think we've already seen a lot of that coming into the market this year, and we'll continue to see that. And then one which I've added is the ESG theme, the environmental, social, and governance. I think we've seen a record, amount of money flow into kind of ESG funds in 2020, and it's an interesting one to watch, whether it's just a kind of theme that's been really successful at marketing certain funds, because there's a lot of gray areas and trade-offs around these funds. A good example is kind of oil companies that are heavily invested in renewable energy. So it's a fairly there's fairly little central kind of global parameters to measure these, and very little true transparency. So yeah, it's one that I'm quite interested in watching. So in terms of future plans, I think one thing which has kept coming up is the use of monthly deposits. So a few months ago, I feel quite strongly about as part of my investment philosophy. Of course, the way eToro works with the copy trading, there is a kind of knock-on effect for some people if they choose not to keep up with this. So the decision in the short term has been that I will continue to send out a reminder for people who want to put in a deposit, and of course they can then choose to do it or not. I will put my monthly deposits into a secondary account, which hopefully down the line there could be an option for people how they copy me, whether they want to do monthly deposits or not. So for now it'll just be a reminder for people to put it in, and I won't put mine in the main account, to make sure that there's no desynchronization for people who are choosing not to put it in. And then I have some working on some project, women investing, but then also for people who come from developing countries like myself, and how do we kind of ensure that people are exposed to different opportunities from a young age. So yeah, I'll keep you updated on that, but I'm going to stop myself there and open up the floor to some questions. Let's pull up the chat here. Feel free to unmute yourself if you have a question. I think the group is not too big, but otherwise I'll just kind of work through the questions. I think somebody had a question about the use of AI. Hopefully I answered that question when I was going through my strategy. I'm going to start with the questions at the end, because I think I may have answered some of them. I've answered the question about monthly deposits. The question about inflation, I mean, that's a really interesting question. And I think there's not like a clear answer right now, whether it's transitory or whether we would see some higher levels of inflation. Hopefully the kind of breakdown of the different compositions of the portfolio gave reassurance that the portfolios will be kind of protected against that in the short term, at least until we kind of see how it develops in the next few months.
Hey, Heloise, can I ask a question, please?
Yeah, of course, please.
Hi, it's Hagai. It's the first time I'm seeing your review. Thanks very much for that. Just if you can reiterate about the adding funds tick or untick, it's always the question, and I'm not sure that I'm 100% clear about it. Open trades, yes or no, when adding funds, and in what position, please?
I think for the it gets a bit complicated when people are not adding funds. It sometimes kind of brings them out of sync. I will be adding funds to my secondary account, so that means you may not get the notification that you've been getting before, but I will send out a reminder for people to add funds monthly. I think a lot of people kind of like the habit, they agree with it, but I don't necessarily want to force it on a lot of people. Because I do understand that some people kind of don't even check eToro monthly, and so I don't want to kind of put them at a disadvantage. So in the case where I'm not adding funds, but you will be adding funds monthly if you choose to do so, I'd probably recommend that you copy open trades, because that just makes sure that the money gets used immediately once you add it, rather than it just kind of sitting there. If for ever some reason in the future I do add funds and you get the notification where you're kind of prompted to add a certain percentage, when that happens, I usually recommend that you don't copy the open trades. That allows people to add less than $500, which is quite useful because that will fit the percentage. But it also means that the new proportion of funds which I have added and you have added will kind of be used separately from that which has already been invested. So that's almost the only time when I recommend that you don't copy open trades. But if you add funds at any other time, especially when I'm not adding, it's recommended that you copy the open trades just so that the money gets invested right away. So
Thank you very much.
That answers your question.
Thank you, it did, yeah, it did. And
yeah, sorry, go ahead.
I've got one sync issue with my portfolio. You've opened, I believe, nearly 2 months now, a position on Coinbase. And from whatever reason, although I was adding funds as instructed by the system all the time, it did not open mine, or it did not copy that trade. And no matter what I've tried with eToro or whatever, it's just out of sync with this position. And as far as I understand, no matter what I will add funds or whatever, it will never be synchronized for whatever reason, that no one could help me on eToro, which I have dealt with the support on number of occasions. So when this happened, there's not much that can be done, and there's always issue. Reading on the comments that people are saying there's always issue with that, and for someone new like myself and many others that are not dealing or managing the portfolio on their own, I don't know. Well, at the moment the Coinbase does not do very well, but I believe that you do it for a reason, and that's what caused the concern, really.
So I think that may have been, I think I'll take the responsibility for that one, because I think what may have happened there is I think, if I remember correctly, that was around the time there was a delay in me posting that I was going to deposit funds. And so what had happened is I had deposited funds, not given sufficient warning to people to add funds, and I had then started using the funds. So that I will take responsibility for that one. It's been a learning on my part, and probably what I might do is, it was only Coinbase. I specifically remember because it was around the time that Coinbase came onto eToro, and so yeah. I fully take responsibility for that one, and I would probably, to make sure that it not other people has affected, I can take it out of the portfolio and add it back, because I think, I don't think it happens very often, but if it's only Coinbase, I think that may have been what happened there.
Thank you very much. I do appreciate your answer. Thank you.
Yeah, just one other thing, since we're on the topic of deposits, I think I always often get a question about, over the last quarter, I held quite a significant cash buffer. I did post about this in one of my recent posts. Some of you may have seen it, but in case you didn't, I think I'll just address that, because I think when I do hold a big cash buffer, I think at one point it was almost 20%, there was a question about, why are you adding money if you also have a cash buffer? And so, yeah, as I explained in my post, I think in volatile times, cash is a really powerful instrument which helps us to hedge the volatility, because it gives us a bit of buffer against it. But then at the same time, if you were watching, I don't know how closely you watch my moves, but you would have probably seen that 20% fluctuated between 5% and 20% nearly on a daily basis. So I was kind of using it for kind of short-term opportunistic positions in the portfolio. And I don't feel, I see that as something separate from adding funds. But yeah, that shouldn't be a question now, since I'm temporarily suspending adding funds to the main account. Just gonna, so there's a question about whether I see a deep correction event during H2, so basically the second half of this year. I think I've tried to address that in the call today, to say that we should be cautiously optimistic. I don't see a deep correction, but I think the market will still be bullish, but definitely less so than it has been. So I think we could expect 2 to 4% growth, definitely not the double digits that we've seen in the first half. But I definitely, I mean, can't say definitely, I don't have a crystal ball, but I don't expect a deep correction yet in the second half of this year, just because some of the stimulus packages, specifically in the US, are not ending until next year. So we won't see rates rising until well into even the year after that. So I'm a bit optimistic that we won't see it in the second half of this year. But again, I have prepared the portfolio to be as diverse as possible, and to make sure that we are prepared either way. Word on cryptos, or maybe not the best time to talk about them today. So I'm actually on a live webinar in an hour, if anybody wants to join, about cryptos and whether we should be including them or not. The short kind of answer, if you aren't able to join that, is yes, they have a future, they have a place in the portfolio. We are seeing a correction at the moment, but I have thankfully reduced the exposure to crypto quite significantly in the portfolio. I think at one point during the height of the recent bull run, we were up to just close to 20%. Right now, we're just at 5%, which I feel is not overexposed. The cryptos still remain fairly uncorrelated to the S&P. They're a really good risk-adjusted return. So I feel that the risk that we're taking for having them in such a small percentage is worth it for the potential of the return. So I think I am getting a message from Hadas that I should keep some time. So with that, I think we're at the end of today, but as always, if you have any further questions, please reach out to me in any of the channels. And yeah, thank you so much for joining today. It was great to meet some of you and to see some of your faces in person.
Thank you so much, Heloise. Always great to hear you, and thank you everyone for joining. We'll see you next quarter. Bye.